eventually it came to a point where 90% of my money was tied up in the company, and I started to realise that I was getting more risk averse than I had been before, because suddenly I had so much more to lose, and it was beginning to hold back the company from growth. And it was probably a good time to let some or all of it go. So we started looking at our options, and eventually we did a deal with Photobox where we merged the two companies together. And Photobox got quite a lot of synergy with our company. They do online photo processing. They were a little bit smaller than we were, but we brought in some venture capital and some bank capital. Our shareholders took 75% off the table, and we rolled a lot of the rest of the equity back in. And now we've got a great business run by the CEO of Photobox. That was the other thing. The other important thing about an exit. There's a certain logic that goes with an exit, and there's an awful lot of personal stuff that goes with it too. Whether you decide that you want to move on and do something else, if you got bored with the business, you can lose your drive after a while as well. You know, I wasn't as motivated as I was when I first started. A lot of things change. But then what you don't want to do is hand over the running of your company when you've got 90% of your assets tied up in it to a CEO who might ruin it. So you have to take enough off the table to have the confidence to let someone else go in and run it. So that was about 2.5 months ago, which was great fun. Yeah.
Nick, can you just tell us a little bit more about the exit? Was the exit with Photobox sort of what you had anticipated? Is it what you were telling your angel investors? And what was the timeline of the exit in your mind when you started out?
The timeline of an exit is always 3 years. It never is 3 years, but it's always 3 years when you start out. I don't know why. I think that's largely to do with when you're raising money from VCs, they want to have a 3 year. They want to triple our money in 3 years. Fine. In 3 years, bit of spreadsheet voodoo. How much do you want to make? You want to make 3 times your return? Okay, there's a formula there. There you go, 3 times your return. There we go, this is a spreadsheet. Marvellous. That is the spreadsheet voodoo. It's very, very easy to do that on day one of your startup, because of course reality hasn't kicked in at that point. It's a little bit harder to justify when you're 2 years in and you're sort of way behind the original curve. But I think the plan always was about a sort of 3 or 4 year. We were always 3 or 4 years away from exit when I started it. Though I didn't think it was going to be that big. I never thought it was going to get as big as it did.
Nick, what next for you?
Well, I decided I got approached to run. I decided I was going to get involved in charity after I'd sold the company. Probably partially because the first thing that most people do when they sell a company is get bored and then invest all their money in another business and lose it all. So there's a strong history of that, actually, entrepreneurs losing all their money in the first couple of years. So I thought I'd keep myself out of trouble. And I'd always been interested in charity and international development. And I was given an opportunity to run a charity called ARC, and Super Return for Kids, which I started 2 weeks ago. Slightly regretting it now, it's quite hard work. It's much hard work than Moonpig. I realised actually how little work I did at Moonpig, now that I have a proper job to do. So that's what I'm doing. Probably the next couple of years, and then after that, I'll probably want to get stuck back in the business.